And it's another trading day right here in Lagos, Nigeria. Great to have you join us. Now, let's take a look at what's coming up in the next 55 minutes. In Nigeria, the Debt Management Office announces the first FGN bond auction of 2024. And the NGX rages on in the green as the all-share index hits the 100,000 mark. Plus, South Africa's annual consumer price inflation continued its downward trend by cooling slightly in December. Hello, welcome to the program. I'm Ladi Williams. First off, let's get the top stories that set your agenda now. So the Debt Management Office has announced the first FGN bond auction of 2024. This comes as the DMO issues the much-awaited bond issuance calendar for the first quarter of 2024. According to the DMO, the first FGN bond auction for the year, which includes 4 debt instruments, is set for January 29, 2024, with the settlement date being January 31st, 2024. The bonds are offered at a unit price of 1,000 naira with a minimum subscription requirement of 50 million naira and subsequent increments in multiples of 1,000 naira. We'll be checking out how much subscription we get for those bonds. In other stories now, we see the federal government is seeking to significantly expand its bilateral trade partnership with India, targeting an increase of over $11.8 billion. The Minister of Industry, Trade and Investment, Dr. Doris Uzoka Anite, made this known during the Nigeria-India Businesses Council meeting held in Abuja. She says the move is aimed at stimulating growth in the key sectors of the domestic economy. While highlighting the importance of the trade relationship between the two nations, the minister noted that India is among Nigeria's top 10 trading partners, while Nigeria is India's largest trading partner in Africa. About 150 Indian companies are currently in, and these include big names such as Bharti Airtel, Churchgate, Stallion Motors, and Indorama. Meanwhile, Nigeria has signed an agreement with India which focuses on development of new and renewable energy technologies like solar, wind energy, small hydro, and capacity building. Let's get a check on oil markets now. We'll see oil prices took a little dip today thanks to worries about sluggish demand and a stronger dollar. But despite that, the losses were somewhat limited because of the whole escalating geopolitical tension situation. So the March contract for Brent crude slipped about 14 cents, about 0.1%, and landed at $79.41 a barrel in early trade. Meanwhile, U.S. West Texas Intermediate crude, those down about 11 cents, ending up at $74.26 a barrel. Now, here's a scoop on U.S. crude stocks. They took a nosedive by 6.67 million barrels in the week and wrapped up on January 19th. And that's according to Grapevine, citing American Petroleum Institute figures spilled yesterday. But hold on, there's a twist now. Gasoline inventories decided to go to the opposite way and increase by a whopping 7.2 million barrels. Quick concerns about fuel demand in the world's #1 oil consumer. And we see that's how the oil market is looking today. And back here, we see the Chartered Institute of Bankers has held its 10th National Economic Outlook with a focus on implications for businesses in Nigeria. The event was held in Lagos. The headquarters of most companies had a rich conversation on possible solutions to projected headwinds from a panel made up of economists, the Director General of the Securities and Exchange Commission, among others. Take a listen.
It's still a season of economic outlooks for the year 2024. The Chartered Institute of Bankers is contributing to the conversation with a tilt to impact on businesses. The experts in related fields are in attendance, but also are the youths. Exposing them to the realities of doing business in Nigeria is the intention.
This step was necessary.
President of CIBN, Mr. Ken Okpara, joins virtually. He welcomes the panel and other attendees and leaves the floor for discussions. The tone is set by the Director of Monetary Policy at the Central Bank of Nigeria, Dr. Mohammed Tumala, who represented the Deputy Governor, Economic Policy. The forecast from the CBN is optimistic for 2024.
the mining, electricity, gas and water supply subsectors amounted to 58, 52, 51, and 69 index points, respectively, indicating, of course, a positive trend.
Then the panel takes over. The outlook is not positive for some of the panelists.
If you have a material increase in cost of lending or cost of credit, what you are going to witness is that these sectors, which I have mentioned that are growing at very slow rates, will not be able to generate the kind of cash flow that will enable them to be able to meet their interest payment obligations and talking of loan principal repayment. So you're going to have increase in default.
2024 should also be a year to look closely at the gas sector.
Nigeria's potential for gas, value-wise, is greater than what we extract from crude oil. And over decades now, not years, instead of, let me use the word everyone understands, is the capturing the gas, we flare it. And then, of course, we had investment in LNG, as you said. And what we have done so far is expropriate 48% of the capacity, which means we still have unused capacity to start with. Secondly, even what we produce oftentimes, in actual fact, have been budgeted for 25 years.
However, there are strategies for way forward.
People talk about comparative competitiveness. Okay? That's what it should be. Comparative competitiveness. Because comparative advantage is not it anymore.
It's the good and not so good, and the participants have to study both sides for progress.
We are seeing some very good policies, from government. And I think what I will advise is really look at policies that have worked. We have quite a number of policies that have worked and learn from them. Okay, and look at policies that have failed and essentially just drop them.
For CIBN, the success of the event is not enough. Following up for implementation is next.
All right, now to our first conversation. The Economic and Financial Crimes Commission and the Association of BDC Operators of Nigeria, APCOM, are teaming up to bring down the dollar rate in the black markets. They're on a mission here. And what else went down there in the chat to see they're giving the green light for APCON to set up a unified website for all the rates and trading stuff for BDCs. And it's like a one-stop shop for all things BDCs at this point. Now, peeking into the Central Bank of Nigeria's data, shows that a whopping $6.11 billion left the country. And that's not all. $3.07 billion of that was earmarked for servicing external debts. Well, Oladipo Ajayi, head of fixed income and FX at Chapel Hill Denham, joins us via Zoom. Great to have you on the show.
Yeah, good afternoon. Thanks for having me on that.
Fantastic. So we see the BDC Association and the EFCC are looking to work together to sanitize, the FX market. Also, APCON is looking at establishing a unified website for the rates and trading platforms, of BDCs. How are you seeing these moves? Will it help in, strengthening the Naira?
Well, to some extent, I feel that one of the reasons why we've been seeing that level of volatility in the market is because of lack of right summary. And I think if AMCO actually worked in partnership with the EFCC and create a page where they can actually condense all prices, I think to some extent they will bring about right summary, which to a great extent will actually remove some form of misinformation that we have been seeing in the parallel market. So I feel that it's a lofty idea, and I think it's a good one.
Right, but at this point, that still doesn't address the issue, of supply. Because at the end of the day, this is a supply issue. There's not enough, dollars coming into the country, and even though it's coming, it's not in the where we need it to be, at this point. So, talk to me about what moves, we should be making right now, the short term, to actually bring some kind of stability in that FX market.
Well, for me, just like what you said, that's not enough to actually cause any great change in the market. The problem on ground is the problem of liquidity. The problem on ground is the problem of depth of FX in the market. So it simply means to solve the problem, there must be a provision of FX for users. So I think the first thing to be done is what the government is already doing. They've been able to actually get more like a stopgap funding from Africa. As we speak, we have gotten 2.25 billion already. We're looking to get a balance of 1.05 billion later this month. And these, to some extent, will create a bit of stopgap in the market and help to actually bring normalcy to a great extent. And aside that, the Minister of Finance also mentioned during the last campus meeting, he mentioned that they're already speaking with World Bank around another 1.5 billion. What this funding will do is that to some extent it will help the central bank to be able to meet pending demands and be able to actually maintain confidence in the market while we are looking at the long-term solution. And some of the long-term solution is firstly, we need to actually improve our revenue generating capacity, and not only in terms of naira. We're talking about dollar FX revenue generating capacity. As we speak as a nation, our core focus is purely on oil. When you look at total FX revenue, close to 90% is actually coming from oil. And I think we need to actually diversify from oil and find other ways to actually generate FX revenue. But that is something that will happen in the long run, but not something that we can quickly bring result. As much as we are looking at that, we should also be looking at the low-hanging fruits around it, and which is a way to actually improve production. As we speak, if you look at our average production for last year was around 1.2 million barrels, if I'm not wrong. But towards the end of the year, there was news that we are now doing about 1.4 million barrels. That's like about 200,000 barrels better down where we were. But when you now compare to what was our allocation from OPEC, we are around 1.8 million barrels. It simply means on a daily basis we are leaving about 600,000 barrel income on a daily basis on the table. And I think this is one of the reasons why we are where we are now. Because if they have been able to produce to capacity, of course, we would have been able to generate more effects, and that to some extent will give central bank power to actually meet obligations on the table. So we need to actually find a way to ramp up production in the Niger Delta. We need to find a way to actually remove that oil in Niger Delta. We need to find a way to actually stop vandalization of pipelines in Niger Delta. And I think if all these are done to a greater extent, it will give us more like a short-term to medium-term stopgap to actually help Naira. But the long run should be diversified fully from oil.
Right, and we've seen the BDC association there saying that they should be allowed to post black market rates, the parallel market rates, online. We shouldn't hide those rates. What do you think?
I think it's a lofty idea, because one of the reasons why we do see that level of volatility, because those prices, they are discrete. And most time when people need to actually get price, you can have 5 different people and they give you 5 different prices for FX. But in a situation whereby you have a portal where you can actually harmonize all prices, it gives you room to actually see what is happening in the market and help market to actually trade appropriately. And what that will do is more like bring about price discovery, and that's one of the things that is currently lacking in that segment of the market.
All right, let's look at the debt level. At this time, we've seen major multilateral institutions raise concerns about Nigeria's debt servicing costs. We see about $3 billion was used to service debt in 2023, and we see that half of the dollar inflows, from about $6 billion, we see about $3 billion of that was used, for debt servicing. Quite a huge chunk. We see the monthly amounts paid out there for January, about $112 million, February, $400 million, March, $92 million dollars. That goes all the way to about I think October, but we see the total value there, $3 billion that was spent on foreign debt service. Should we be worried at this number?
Yeah, sincerely speaking, Ladi, I think we need to be worried that the issue on the table is not even in terms of the insurance element. The issue on the table is that it means that we are not generating enough FX revenue. Imagine the totality of revenue that comes to Nigeria as a country is 6.1 billion. I don't think that is good enough. It simply means that we are not generating enough FX revenue, and that's what we have discussed earlier on. And aside the 3.1 billion that you actually mentioned, from this year we are going to spend about 1.2 billion on Eurobond bond payments for this year. And I think one of the solace that we have this year is that there's no maturity for this year. So I think that's one of the reasons why the amounts we have to spend on servicing Eurobond for this year will be about 1.2 billion naira. So for me, I think it's something that calls for concern. Now, as much as we speak now currently, those obligations are there on the table. We need to meet them. So what we need to do is to actually find a way to improve revenue generating capacity. And when you are talking about revenue generating, like I mentioned, it has to be on. We are talking about the dollar side as well now. So it means that what can we do as a country to generate more FX revenue? How would we? What can we do to actually help to actually encourage exporters to actually generate more FX revenue? Sometimes I think some of the bottlenecks that we have at Nigerian port, some of the problem are there sometimes because sometimes exporters find it very difficult to actually export their product outside the country between the place of actually conveying the product to the port and at the time at which the product will leave Nigerian seaport. Sometimes takes close to 2 weeks, and I think that's not good enough. We need to actually improve on that side as well. So it's in totality, we have to look at any way that we can actually encourage inflow of FX revenue into the country, because as we speak, we need to build some obligations. And these obligations are on the table, and we don't want to get to a level where we will now start throwing the part of our African brothers, and I don't think that is good enough for the image of the country.
Talking about obligations, you see Nigeria is trying to offset about $7 billion backlog at this time. About 20% has been paid off, in about 3 months. How would you describe, the pace so far, in clearing the backlogs? And how do we balance, debt servicing and also trying to clear most of these backlogs?
So, if you look at the totality of backlogs, around 7 billion, we've done about 2 billion of it. For me, I think it's better slow than not doing anything at all. And one of the reasons why we are where we are now is because the last CBN government did not do much around that, and that's why we are still at this level. But even at least to some extent, it's encouraging that the current CBN government is looking at way to actually reduce or totally pay off some of these obligations that are currently on the table. I think it's better slow than we're not doing anything, and to a great extent I applaud the current CBN government looking in that direction. And like I said, the problem is the fact that we are not generating enough FX revenue, and we can see the impact actually overall affecting the economy overall. We can see it in inflation, we can see it in prices of things, and so I think the government needs to prioritize these and find a way to actually offset some of these obligations so that we can start on the fresh note.
Right. We did see that report that Nigerian banks will impose an electronic money transfer levy on foreign currency inflows equivalent to about 10,000 naira and above from this month. What impact would this new electronic money transfer levy? What impact would it have on remittance costs?
I think that sometimes our policies are somehow. Because sometimes we take 5 steps forward, we take another step backward. It's always very concerning for people. In a situation whereby we are trying to encourage people to actually influence FX, it's not a time where we need to actually level or increase the cost of actually remitting money down to Nigeria. I think it's even a time that we need to find a way to reduce the cost so as to lure most people to actually bring in money through the official channel. The end goal is that a lot of people will not bring in their funds through the official channel. What this simply means is that people will resort to more like P2P form of exchange, and so it simply means that I will move direct to you. You send the dollars to wherever I want to move the money to, and this is not the best for our country in such a time like this. I don't think it's actually right for to actually impose that 10,000 levy on the remittance. I think it's a time where we need to motivate people, or it's a time where we need to lure people to actually bring in money than actually discouraging them with fees.
Yeah, because we need more of those remittances at this time. But what do you see for the FX market in 2024?
Yeah, for me, I think there's still light at the end of the tunnel. And my view is premised on the fact that if you look at it critically, I'm very, very sure that prices in the parallel market is showing that Naira is actually undervalued. And that's not the real picture of the country. And at times like this, you see volatility, you see speculators, you see people that actually had a future obligation trying to actually position now or buy now because they don't even know where the currency will trade at that particular point in time. But I think that it's going to be better in the year 2024. My views are premised on the fact that for a better part of last year, there was clamoring that NPC were not actually remitting money to central bank, and the information is simply based on the fact that whatever accrues to the country as revenue was actually used to actually import refined product, and to a great extent we weren't having enough aggression into our reserve, and that also reduced the capacity of the central bank to beat FX obligation. But with the emergence of the Dangote refinery, I think it sounds better for us. And when you look at the capital position for Q3, and if you look at the first 10 line item on that deal, you see that the totality is about 3.7 trillion thereabouts, and close to 80% of it is basically for PMS, gas, gasoline, oil, and also jet fuel. It simply means that close to 80% of the import bill is simply for oil, for PMS, for diesel, and the like. So I feel that with the emergence of Dangote refinery, it simply means that we may not be expending as much dollars as what we've been doing in the past. So it simply means that NPC can sell their crude oil and generate their FX without need to actually import refined products. So it simply means that there will be a lot of aggression in our reserve. It also still means that the central bank will have more power to meet needs and meet the obligations of the people. Right. So I think that now it could be very volatile. Now, and I guess that's one of the reasons why the central bank is trying to get more like funding to create more of a storm gap while we are looking at Q2 for better placement of the current currency by then, because by then we expect that Bote to have a producing capacity by then. We don't expect to actually import any diesel, PMS, gas oil, aviation fuel in any direction. So it simply means that we have more dollar to play with, and that we have more capacity to meet obligations. So I expect Naira to actually appreciate this year 2024.
All right. Well, let's hope for less pressure, going forward on the FX market, and countdown to the first meeting, the NPC meeting, and that's next month. We're all looking forward to that. Thank you so much for coming on, Mr. Oladipo Ajayi, Head Fixed Income and FX at Chapel Hill Denham. Thank you.
You're welcome, Daddy. Thank you very much for having me.
All right, let's head straight to the market now. The all-share index, 100,000 hit at intraday, and we have Anita with the details now. It's going to bring us up to speed on how we got here. 2.31%. We've been seeing constant 2% rises right there in the market, and definitely Anita will have the details at this point. 100,000. Yeah, you hit your bet.
I wish you put that wager, because I was ready to make some money off you.
Yeah.
Because I was very sure. And when I told you about by
100,000
coming back, back in with his predictions, and
exactly.
Of course, myself and some couple of other traders, we were discussing just a couple of minutes ago.
Right.
He said it's not just about hitting the 100,000; it's still going to climb above the 100,000 level.
Right.
Before it makes some pullback, already.
So I wonder where the high point is going to be at this time.
Well, because in the history, let me say this with so much authority. In the history of the Nigerian Stock Exchange, where the stocks are traded, we have never seen this high, this historical high, and it's something that is worth celebrating. Particularly looking at, we closed the year 2023 at about 40+%. But as we speak now, the market just in January, just in the 3 weeks of January, we're at 34.18%. Can you beat that?
I can't. I cannot.
Exactly.
Just prepare the champagne after the show.
Exactly. And talk about where to put your money to beat inflation. The stock market, Nigerian stock market, is the one to talk about.
Fantastic.
Now let's look at our board. Okay, so Ladi, I'll come back to you. So now let's take a look at our board there, Nigerian stock market. We're talking about the Trading Day Africa. First, Nigerian stock market, which is number one on that list. Take a look at your board there. We've been talking about the 95,000, 97,000, 98,000, and now can you beat that? Way above 100,000, even almost bracing towards 101,000 index point. The highest so far. I've been on this market about two decades now, but I've never seen this level for the market. Maybe the market was just about this size when I came in, but it is more than several digits, at about 2.31% at intraday. Now, for other sides of the market, we still see South Africa, another big market on the continent, making a 1.32%. Most of the markets in Africa were in the bullish sentiment, except for the Kenyan Stock Exchange, which was ended Tuesday's trading session in the red. If you can take a look at the board there, it was down by 0.49%. But there's the Egyptian Stock Exchange, the EGX 30, it was up by 0.26%, which you see on your board there. So that's it for that market. And then, of course, for the Middle Eastern market, we see also some bullish sentiment also pouring in there. Lots of bargain hunting going on there. We see particularly for the Dubai FM, which was up by 1.67%. And then for the Abu Dhabi, which is both of them are on the United Arab Emirates Stock Exchange. So that's it. It was up by 0.05%. For the two markets on the UAE. On the other side of the Middle Eastern markets, where we take a look at the Saudi Tadawul. We'll be talking about the Saudi Tadawul, which at some point had some Indian investors going into that market. So we see it up by 0.55%, and that's the biggest stock market for the Middle East there. For the Qatar index, it's also a green number, a green picture, a green arrow, whatever side you want to call it. Arrows or green or colors, that's it. So, but also we'll be talking about other markets on other sides of the world, but let's still maintain our focus on Nigeria's stock market or on Nigeria's financial market. But this time, talking about the fixed income market, where we see the Treasury bills auction being carried out as we speak at intraday. And then to give us more details about that, let's talk to Bosun Obembe, who is a fixed income dealer at Access Bank, to give us more details about the proceedings for the PMA going on at the market there. Thank you for joining us, Bosun.
Thank you for having me. Good afternoon.
Okay, now I have about 3 questions, if not more, for you. First, I would like you to review the market. What we had the proceedings yesterday for the Treasury bills as well as the bonds market. We saw some bearish sentiment on the bonds market, but for the Treasury bills, we saw a kind of a mixed picture. But you can give us the details. So how was it yesterday for the markets?
So on the fixed income market yesterday and the Treasury bill, given that today we have an auction today, like you mentioned. So what happened was most market participants, they were a bit cautious, so nobody wants to take position because today there is an auction going on and the expectation is ready to go up. And the same sentiment went into the bond auction. We had a bond auction calendar that came out during the week, and expectation is the rate will go up at the next auction coming up next week. So it was a bit of a quiet market yesterday, but the result of today's NTB will give an idea of where our market will go in the next few days.
Okay, so now you talk about where the market would head to, and we see that first the Debt Management Office has released the first quarter bond auction calendar, and also has unveiled has begun the January FGN bond auction. So can you give us details about this, particularly when about 4 instruments are involved? Give us details about this.
So the calendar, every month we see DMO coming up with an auction, 90 billion each on different maturity. So there's nothing new in what they've done. The only difference in this month is there's a maturity 2053 that used to be on the auction, but it was removed and it was replaced by 2027 paper. So the expectation is that DMO doesn't want to borrow, doesn't want to float this long-hand bond, so they've replaced it with a 2027 where the rate there will be lower than what it will be for 2053. So the auction will start next week, and the expectation is that rate will go up. At the last auction, the 2053 closed at about 17.5, but it's trading at 15 levels now. So DMO is going to borrow at a lower rate, but given that there has been an improvement in the market liquidity, and with the today's NTB auction result, where we saw the yield on the 364 day closing at 11.4, we expect that next week the auction will be oversubscribed, given the improvement that we've seen in the money market liquidity. This week we have some coupon payment on 2026 paper, 2030, 2024 papers, about 194 billion in coupon payment came into the system, which has improved the system liquidity. Before now, system was in the repo, but now market is liquid. So next week, my expectation is that the rate at the bond auction, which will take place on Monday, the rate on all the instruments on offer, 90 billion each on 2027, 2029, 2033, and 2030, that the rate will go up and it will be fully oversubscribed.
Okay. So now, yesterday, so we saw another FAQ, that's the December FAQ being announced by the Federal Allocations Committee. So how is this going to play into the market when we go into next week, the final week of January, where, of course, we've seen not much of activity within the fixed income space, but how is this and other auctions going to affect the markets?
So the FAQ is going to improve system liquidity. Like we know what drives the market is liquidity. So opening this week, market was in repo. By market being repo, meaning that most banks, they went to the CBN to borrow funds because they could not finance their transactions, so they went to the CBN. But with the FAQ payment that will come into the system, this will improve the system liquidity, and this will ensure that banks and market participants, they have capacity to actually bid at this auction. Because if you are not fully funded, or if you are in the CBN, you are funding from the CBN window, you are not eligible to come in for the auction. But with this FAQ coming in, and with CBN reducing the discretionary CRR, which actually took system liquidity to this current level, like I said earlier, I think the bond auction will be oversubscribed, because that is where banks and market participants can put in their excess cash to earn some good yield, just like you mentioned for the equity. So there's some good return that someone can get from the bond market as well.
Very, 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 very nice. And then we'll be looking out for that, Bosun. particularly for next week. So that was Bosun Obembe, fixed income dealer at Axis Bank, giving us details about the fixed income market. So now let's go back to the board for the U.S. market. We saw that the stock futures there, they were in the green, and this is because they will be expecting some earnings reports later from IBM and some other market components. Other stocks will be releasing their latest corporate results, and then also for the Asian markets, they were also in the green. Like the tech stocks were the major drivers, but of course we saw a little bit of pullback on some of those Asian stock markets at the close of Tuesday's
Yeah, all eyes still on the U.S. markets at this point. They're all waiting for what the U.S. Fed is going to do next when it comes to rates. But now talking about the NGX, I'm wondering now 100,000 is conquered. Is it too early to call for 200,000?
I think we'd leave the 200,000 for the better part. Don't forget, we're still in January. We're not even in the first quarter.
No, I'm saying sometime in 2024.
Yeah, I think.
Is it too early?
My crystal ball is not that futuristic, so I think I'd rather leave it to the first half of 2024 before I can make any predictions.
Like this number looks a lot right now. Yeah, the market gypsy. Anita, thank you so much for the details right there. All right. Let's get a check on what's happening in the U.S. Let's get a sense of how the markets close in the U.S. Mark correspondent Marie Bird.
The U.S. stock market was mixed on Tuesday as the Dow Jones was down at 0.2%, a disappointing day for those corporations on the Dow. But the S&P 500 was up at 0.3%, and this was another record-setting day, as many investors are watching to see how the S&P will continue to respond over the next few days. The Nasdaq was also up on Tuesday at 0.4%. The tech industry rallied for the day on Tuesday. It means that we could be seeing some upward swing in the tech industries over the next days and weeks ahead.
That was Marie Bird giving us the close from the U.S. markets. But let's get a check on London now. We have Juliana joining us from our London studio. Great to have you, Juliana. So we see the regulator Ofcom's calling for Royal Mail, that's the Universal Postal Service, to modernize their operations at this point, saying they can save some cost, if they deliver goods at like 3 times a week or something. What are you hearing about that?
Good afternoon, Laddie. Well, yes, I think this Royal Mail review is going to cause lots of complaints across the UK, because even though it is a private company now owned by International Distribution Service, of course, we know that the Post Office and Royal Mail are very closely linked to the British public. But, of course, digital communications has really changed the way we all communicate with one another, and people are just not sending letters in the way that they used to, and that's really upended the business of Royal Mail. And we know that because of the Communication Workers Union, which represents staff. They have conducted a series of industrial action over the past few months, one of them being about their pay, jobs, conditions, which is a kind of buzz term in the UK for strikes. But really, it's just the way they operate, which is why Ofcom, the regulator for communications in the UK, decided to conduct a review, basically asking consumers and businesses questions about its operating model. And they have decided that change certainly needs to be made in order for this old firm to be able to survive in a really different world. So one of the suggestions is that the universal service, which is how the company operates at the moment, basically the Royal Mail is mandated to serve every single address in the UK for 6 days a week. So that includes a Saturday service. And again, Ofcom don't think that's sustainable. So one of the suggestions perhaps is that the Saturday service will be removed, or even that we would only receive mail 3 days a week, not the 6 days that we're used to. So the Communication Workers Union, the union that represents staff, as I said, they're not happy about this review. They haven't been consulted, they say, by Ofcom before they put some of these potential changes to the public. They want to go back to the drawing board, speak to their members and get some suggestions. So like I said, it is going to be a humongous row because no legislation or reforms at this stage can take place without a vote in the Commons and some sort of public consultation. But I believe that Royal Mail have the capacity to deliver 20 million letters every year. Last year, I think they 20 billion actually. Last year they delivered just 9 billion. So it just goes to show that people now are picking up WhatsApp, aren't they? Or putting emails. They're not really sending letters as they were. So certainly I think everybody agrees that they're going to have to change their business model in order to survive in a very competitive delivery service market.
Times are changing, and I'm sure Royal Mail will be feeling like they're being called out, at this time. But let's look at other issues now. See that according to analysis from a leading consumer group, a monthly motor insurance payment can cost hundreds more, than paying annually. I guess right here in Nigeria we pay, annually. So I guess that's good.
Yeah, that's interesting, actually. It'd be interesting to see how much insurance is in Nigeria for a car. We should actually compare it because this is all...
Yeah.
I would actually be really interested in knowing how much it would cost to insure your car in Nigeria.
It's actually gone up. It's actually gone up. It was much cheaper before.
To insure your car in the United Kingdom, I can imagine, Laddie. But I think that's one of the reasons why which is a consumer relations group, have put pressure on the FCA, the Financial Conduct Authority, to look into the practice, because I think most people are aware if you have an option to pay annually or an option to pay monthly, of course it's cheaper at the time when you're paying in the month, but you are going to be paying a premium service. But I think which now think that, it's just totally out of order, because of course it's always vulnerable individuals or vulnerable households that end up paying more because you just cannot afford it. And I think one of the reasons why which are taking, this fight to the FCA is because we know that everybody who drives a car, it is a legal requirement to have motor insurance. So because it is a legal requirement, they just don't see why somebody who cannot afford to pay, whether it's £2,000 to £3,000 or £4,000, equivalent to about 5 million naira a year. And, if you want to pay it in a month, you pay so much more, hundreds of pounds. I think they noticed that some customers were paying up to £350 a year more just because they can't pay that annual payment. So there has been, I believe, the Society for Motor Traders and Manufacturers, they've responded to some of the warnings and the claims by which, and they said, yes, there does actually have to be a review into this, looking at how customers, some of them are, paying high profits for these firms. But at the moment, this is exactly, I think it's across the board. So if you pay monthly, you're always going to pay a couple of pounds more than somebody who pays every year. But should it be hundreds of pounds? That's the big question. And we'll just wait to see how the Financial Conduct Authority respond to the claims by which.
Right. We'll definitely be looking out for that figure exactly. But how are the markets looking in the UK?
Yeah, tip-top shape in the UK at intraday. The all share is up 0.31%, FTSE 100 up 0.29%, and the FTSE 250, the domestic market, up by a whopping 0.62%. In the currencies market, the British pound is also trading up against the US dollar by 0.64%, up 2 against the euro by 0.2%, and up against the Japanese yen by 0.13%, Laddie.
All right, so I guess the market is up right there in the UK. Thank you for the update, Juliana.
Thank you.
All right, let's get a check on Europe now. See, Germany is getting ready for another week without train service, as the train drivers union is on strike again. Well, Lance Halter joins us right there from DW in Berlin. Great to have you, Lance. So, any trouble commuting this morning?
Thanks for having me, Eladi. Yes and no. Fortunately, it has been known for a few days now that Deutsche Bahn would once again be on strike. So I simply switched to my car driving in this morning. Otherwise, yes, I would have been in trouble because the German rail provider is not only running those long distance trains, the ICE and cargo trains, but they're also in charge of some of the local metro trains, including the ones here in Berlin. Anyway, this is the second strike this month and people are getting really annoyed. The Deutsche Bahn doesn't have the best reputation to begin with anyway, with trains constantly being overcrowded, almost always late, oftentimes not even reaching their destination because of whatever technical difficulties they might be facing. And now the company's reputation is taking another hit. For a full week now, people have to make arrangements, and it also costs them a good amount of money. Management puts the cost of the strike for Deutsche Bahn at around 25 million euros per day just in lost business.
Deutsche Bahn is not the only one suffering here, right?
That's right. As a matter of fact, Deutsche Bahn, with an estimated cost of 25 million euros per strike day, is not the biggest victim. The German economy in general is. Here's the thing. Besides the passenger trains, as I said, the cargo and freight unit is also on strike, and those cargo trains are needed. Companies get their supplies by train. They ship their products by train. That could be cars, machines, chemicals, or agricultural goods. Really just about anything you can think of. And now for a few days, the economy might be running just fine without trains coming in and out, but very soon some companies might be running out of supplies and might need to cut back on production. Germany's Institute for the Economy has calculated that could cost the economy around 100 million euros per day. And if things got really bad and some companies would have to halt production of their goods, the tally could go up to 1 billion euros. And the damage is not even confined to Germany. It can easily spread to other European countries. And that is because Germany, of course, is situated right at the center of Europe. And that means most of the EU-wide rail traffic cuts through here. In fact, 6 of the 11 main European rail lines go through Germany, including those connecting the big ports at the North and the Baltic Sea to countries in southern Germany, the Mediterranean and eastern Germany. So these train drivers asking for just another 2 hours off every week really got all of Europe screwed.
All right, we'll keep tracking that story. What are investors looking at in today's markets?
Well, starting in Asia, the Japanese yen is up this morning. That's as traders are expecting the central bank in Tokyo to end their stimulus measures. Japan, in opposition to every other central bank's policy, had kept its interest rate near zero for the past few years. And while the EU, the UK, and the US and others are all hopeful their interest rates will be cut sometime soon, after years of being upped, of course, in Japan, we're looking at a whole different dynamic. Then over in tech stocks, we got some numbers from chip equipment maker ASML. The Dutch company says its net profit rose, and that is despite a high-tech trade spat between China and the West. Remember, ASML is one of those companies that are no longer supplying the Chinese market with some of their technology, and that's part of the West's effort to restrict China's access to some of the very latest chip technology over fears they could be used for advanced weaponry.
All right, thank you so much for the update from Europe. That's Lars Halter right there in Berlin. All right, let's take it out to Southern Africa. We see South Africa's annual consumer price inflation continued its downward trend by cooling slightly in December. Stats South Africa announced that annual CPI was 5.1% in December 2023, down from 5.5% recorded in November 2023. The main contributors to the 5.1% annual inflation rate were food and non-alcoholic beverages, housing and utilities, miscellaneous goods and transport. And we see economists here unpacking this announcement. Take a listen.
Consumer inflation moderated slightly more than expected to 5.1% in December from 5.5% in November. This downside surprise was to a large extent owing to even lower than expected food inflation at 8.5% from 9% in November, and this decline was quite broad-based. We do expect food inflation to continue to moderate over the course of the year, despite the El Nino, which gave us above average temperatures over the last couple of months, but so far still reasonable rainfall in key grain-producing areas. And given that we've had more than 3 years of above average rainfall, soil moisture levels are quite high, and so that is then also supporting the current crop expectations. Rental inflation in this data increased slightly but remained very low at 3%, which should give the Reserve Bank comfort that there's still no evidence of demand-driven inflation. We expect the Reserve Bank to stay on hold at this week's NPC meeting, but we do expect some interest rate relief from the second quarter of this year.
I am very happy, and so are many people, that the inflation rate or the CPI figure for December 2023 is down at 5.1% compared to 5.5% in November. Is very encouraging because it confirms our belief that the South African inflation rate trend is now pointing downwards, as it is the case globally. And that confirms that tomorrow we must be relaxed. The South African Reserve Bank's Monetary Policy Committee will decide to keep the repo rate unchanged at 8.25%. The reason why the South African Reserve Bank's Monetary Policy Committee will not cut or will not start cutting the repo rate, it is because the overall inflation rate in South Africa for 2023, the year as a whole, is at exactly 6%, which is at the top end of the Monetary Policy Committee's target inflation rate of 3 to 6%.
All right, there you have it there. Inflation slowing also in South Africa. Can't wait to report inflation slowing also in Nigeria. But let's take a look at the crypto market now. We see some green. Back in the market, it's been red for the back-to-back now, but we're still seeing Ethereum still staying in red, BNB still in red, Solana's deeper in green. So we're seeing some kind of comeback for most of these currencies right now. Let's look at the top stories now. We see Coinbase introducing non-custodial crypto wallets. So at some point, Coinbase investors can also have some of these assets, held in their own, custody. You don't have to put it, right there in Coinbase exchange. And we see OKX looking at compensating some investors there with the price of OKX token there dropping more than expected. So they're going to be compensating some of their investors at this time. Let's bring in Shehu Dania now, CEO, Alpha Geek Technologies, join us via Zoom. Great to have you on the show. We're seeing some green on the screen this time, even though we've had red, back to back. So I guess the question is, how low can Bitcoin go, and is the sell-off over at this point?
Well, Bitcoin can go very low. And so right now, analysts say it can go as low as 30K because there's been mass sell-off from large institutions. Unfortunately, the ETF approval came with, it didn't come with the expected reaction from people. So some large institutions have been taking profit, and it could go as low as 30K, but then of course it also helps with stabilizing the markets, so that new entries, new money can come into it. So right now we're seeing green. Everyone seems happy, but not so happy, but at least we're experiencing some recovery compared to the previous days.
Yeah, investors don't like when the market is red. But Shehu, looking at the issue right here in Nigeria's, FX market, we're seeing the naira really pressured right now. We've also, heard talks about central bank digital currencies. Talk to me about how technology and CBDCs can play into these FX markets, because we're all looking for transparency in that market. Talk to me about how technology can help here.
So I think the CBDCs are fantastic, and I know recently the Africa Stablecoin Consortium will come up with, the CNGN, which is a privately held stable coin for the naira. So let me just use this. So imagine the guy in China, the guy in the United States who's doing business with the farmer in Nigeria. The farmer in Nigeria is exporting his products and he's getting FX, that's his US dollars, right? Applying technology, tokenizing the naira, making the naira available on the blockchain, on the public blockchain, available on several exchanges across the globe, allows the person from China, from United States, from whichever country, Indonesia, who's buying products from Nigeria, to then start to demand naira. Because the farmer there, at the end of the day, even when he gets the money in US dollars, he's doing his business in naira, so he needs naira. So we cut all of that and get people outside the country to start demanding naira. And right now, for anyone to get naira, you need to first come into Nigeria, have a traditional naira bank account. And most of those people do not have any business in Nigeria. All right. So using technology, putting the naira on the blockchain allows them to be able to access naira. People in Nigeria no longer have to be clamoring for US dollars. There's the people outside there that will then be looking for naira and buying the naira and paying for services that they are getting from Nigeria. And that will, I know for a fact that we can strengthen the demand for dollar will then reduce, and then we will increase demand for naira globally.
Right. I guess, as they say, if you want to break a country, break its currency. But I guess now what we should be doing is looking for ways to create demand for the naira, strengthen the naira, hashtag strengthen the naira. Thank you so much for coming on. Shehu Dania, CEO, Alpha Geek Technologies. Thank you.
You're welcome.
All right, so that's the market now. Fear is gradually creeping into this market. We're seeing 48 points. We've been used to that 70, 80 point level for the fear greed index, but it's still neutral right now in the crypto market, but we're still seeing fear starting to creep in gradually. That's the show today. Thank you so much for watching. Don't forget, you can visit www.channelcv.com for more updates. Also, go on YouTube. You can also watch this show again. I'm Ladi Williams from the team right here at Channels HQ. It's bye for now.